So let's talk about the power of dividend investing. Let me pose a question to you guys. If you invested $5,000 a year into a dividend portfolio that averaged a 5% dividend yield, and that 5% grew at a 3% increase a year, so 5% the first year, and then about 5.15-ish the next year, and so on, how much income would your portfolio have by the time you turn 62 if you started when you were 25?
Assuming no growth, share price growth.
Yeah, when developing the model and doing my little chat GPT magic, I didn't want any growth on the stock because it's too subjective. So keeping the stock price the exact same from 25 to 62, just starting at 5% and then compounding that dividend by 3% growth a year, what would that number be? First year being $250, and then it would grow all the way to what? What do you think?
Obviously, it's a lot.
Yeah.
Something that I wouldn't think right offhand.
Right. It's going to be...
It's a lot.
Great. Yeah.
You know the answer. It ends at 62 at $257,000, which is just insane.
That's amazing, yeah.
Considering you invested a total of $200,000 over a, 37 year period.
That's assuming you stayed in there for 51 years. That is the number one problem.
37 years. Yeah.
37. Yeah. But assuming you stayed in there for that long, I just have to point that out because we have people that'll ask every single week, every single day, well, what did you do yesterday? So the biggest thing is keeping it in there. But if you do
actually,
keep
that's
it in
a good point because I think so often, we're in this mindset of what am I going to get now? And that's the point of this entire show.
Right.
We have this, even as advisors, this need, want, desire to see $100 turn into $400 as fast as possible. The example I just talked about shows no growth of anything. Can you imagine? Can you imagine being in a portfolio where you're buying a stock and it never grows for 37 years, and you have, and by the way, the value of that portfolio started at $5,000. By the time you hit 62, it would be 1.7 million, and you had no growth on the stock price.
There would be phone calls.
Yeah.
Every annual review would be like a dogfight of like, no, trust me. Just trust me. Your income's growing. I promise. Watch, it's growing, and it's going to work out.
But the custodial statement from Fidelity, Schwab, wherever, is like, but you have no growth. Like your cost basis is at zero. You have nothing, and yet you turn 5,000, or you turn 200,000 into 1.7 million, basically kicking off more money, $57,000 more income than you invested in this
per year,
right? At age 62, like that's insane. And the crazy thing is, you're going to say, well, what if the company didn't pay? What if they didn't pay their dividend?
There's always what ifs.
There's always what if. And there's companies, this is 37 years of payment and 37 years of consistent increases. Yet, if you look at the marketplace, there are companies that have been paying for 100+ years. There are companies that have been increasing their dividend for 65 years, twice as long as the example we're giving here.
Yep.
So this isn't outlandish at all.
No, you can definitely find a whole host of companies that would fulfill this exact example.
So let's focus on really consistency of our conversation here on really patience. When we're going to talk about dividends, we're going to talk about the value of dividend investing. I really just want to focus right now, or actually for this entire show, on just being patient. So let's give a couple examples. There's 4 examples of 4 people that used patience and dividends to build wealth. The first one was Ann Scheiber.
Scheiber.
I say that right? So she started investing with $5,000 in 1944, which, by the way, was a gigantic sum of money. She got it as a bonus. She was an executive assistant, and she had saved up this money through bonuses. And in 1944, she invested this money, and she just did little bits of investment from that point forward. She never made more than $3,150 in a year.
That's
crazy. That was her max salary in her entire career. $3,150. I can't even get my head around that. That's like a paycheck for people today, right? And when she had passed away, she passed away in 1995, and she had left over $22 million in wealth in just the market, and 100% of that was in dividend stocks. She turned a $5,000 investment into $22 million because of dividends.
And she probably was living off of some of that too in
I
her
would
retirement.
imagine.
Like it's not like all of it was being reinvested, and it still got to 22 million.
Unbelievable.
My quick look at her though, she was 1 of 9, left nothing to anybody, left it to a school to help young women. She had an interesting life. She was a little too frugal, but to all those folks, we talk about patience. But one point I'll say, you got to get in first. And this actually back then was a lot of money. But when I first was looking at it, I was like, $5,000. A lot of people are like, oh, I can't even get in with $5,000. So you're not even in yet to even start being patient. Interesting here, just getting in and what she was able to do over that time once she got in. But even getting in, I don't know if you guys talk to a lot of people who are like, well, I don't have enough. Do you even want to talk to somebody like me? I don't have enough. And then you look at somebody who, again, 5,000 back then was a lot. But
that was a lot.
You say, I don't even have enough to get in, and they don't ever get started. And another person, I don't know if you knew Grace Groner. She was an orphan, a twin orphan. Talk about somebody who had nothing, right? 180 and
$180.
$180, like a few shares at, what was it, Abbott Labs?
Yep.
Where she was working. But she was an orphan at age 12. And talk about having no money and not getting started. That changed her whole life and the lives of so many, because now she's given back her life to go and serve others. But it's just interesting. The point that I guess I'm trying to make here is, so often we talk about patience once you're in, which, that earlier point you were making, Paul, and Kyle was talking a little earlier, like that never grew. Get in. It's just amazing if you can get in, even if you don't have enough you think.
Well, you look at Grace, to go back to her, she invested $180 in Abbott Labs, and I think she only owned Abbott Labs. That was the vast majority of her holdings.
I think it was 3
because
shares.
she worked there.
Yeah.
And
it was like I think it was a gift, like a stock option.
An option, right?
Yeah.
And then she had turned that $180 investment into over $7 million by the time she passed away in 2010.
Yeah.
75 years.
Yeah.
It occurs to me that maybe people from that era understood the idea of patience and dividend growth more so than, we have that I want it now mentality more so today.
Yes.
Growth has changed the whole mindset. Too.
Well, and you see so many companies now that can, in a year, they can go 100+%. And it's exciting, right? Everyone wants to have that story at their cookout. Nobody wants the one where I'm still plugging away.
Yeah.
I've been in the market 50 years now.
Now I've made it.
So another guy was Ronald Reed. He had amassed $8 million fortune by the time of his death in 2015, where his portfolio was generating over $20,000 a month. And these are people who are just like you. I mean, people that, don't make tons and tons of money. I'm sure there are people that had, Anne, the first example, she had a lot of money to start, but then just put peanuts in every year after. And then Grace, she just put in a few dollars, and then Reed's the same thing, just a little bit of money over time. He was he had generated $240,000 of dividend income a year, and he never had a lot of money. He just put in little bits over time. And then the last one is probably the most well known. Everybody knows him. Nobody thinks there's just little bits of money with this guy. It's Warren Buffett.
Exactly.
Warren Buffett's arguably the greatest investor of our generation, probably arguably all time, came from nothing and turned nothing into a whole lot. And his whole thing is dividend investing.
Buy something you'll hold
forever.
Like even the companies that he goes and buys, it's all for their income.
Mm-hmm.
Like he goes.
And every example we've given, all 4 of these people, and there are countless more, every single one of them took time, took multiple decades and decades of time to build wealth. Now,
even Buffett, like we were talking, we had seen a screenshot of his wealth over like his career. And it's really only come since he hit his 70s or 80s. It's like gone totally hockey stick curve.
To say that a different way,
Yeah.
the vast majority of Warren Buffett's wealth has come after the age of 60, 78, or whatever age it was. But it was like 95% of his wealth happened on the tail end of his investing career.
Yeah.
And I think that's where we have this focal point of like, no, I want it in the next 5 years. You know, the most successful, wealthy people that don't have to worry about income grow this over time. It doesn't happen overnight. And this is an interesting question. How would your life change if you could build a passive income stream that through dividends that covers all of your expenses? And there's two ways that clients can do this. You can do it like all these examples where they start young and then they build it slowly over time. Or, you know, more often than not with our client base, they're coming in right before they retire or actually in retirement. And they're saying, hey, I have this nest egg. And then we buy a portfolio with that nest egg. And now we can build generations of wealth for their generation and beyond because you're starting with this huge value. It would have been better if we started long ago, but to Nikki's point, you got to start.
You got to start.
You got to start. Yeah. So you can start with a big amount, but then from that big amount moving forward, it's crazy what can happen.
You know, if you haven't been investing like this your whole lifetime, just coming in with a big chunk of money might scare you to death. The market could drop 50%. You know, 2000, 2001, just it goes away.
Well, and Paul, the other thing, when you're, and Kyle said it earlier, when you're sitting around, you're listening to the news, when you're listening to the talking heads, this is not what they're talking about. So it's hard to get in, go left when everybody else is going right. When everybody's talking growth and, you know, the high numbers, and for you to be able to focus on that, what, $5.06 a share if you're talking about PepsiCo, one that's near and dear to me. How do you sit there and talk about $5.06 when everybody's talking about this exponential growth right now, right? Going left when everybody else goes right. Pays dividends, for lack of a better way to say it, later, but it's, again, it's hard to stay in it.
So
it's hard to be patient.
On this passive income stream, one of the core conversations I have with a lot of clients when you talk about, hey, like, what are your goals for investing long term, and like, what do you want to see in retirement? They almost all of them bring up, I'd love some passive income for maybe some real estate. You know, like they're thinking real estate to draw passive income. But typically to get in on real estate, you've got to have
a big chunk of money.
Big chunk of money.
Or be able to handle a lot of risk.
Right. And then you got to deal with being a landlord and tenants and all this stuff.
Don't watch the news on that nowadays.
You can almost get the exact same benefits with slightly less risk. You may not make the same type of return on a percentage basis, but you don't have the same headaches and stuff.
So let me ask this question again. How would your life change if you could build passive income through dividends or passive income period? Obviously, we're very biased on dividends. That covers all of your expenses. I had a client in my office years ago, and I remember they came in, they're a super fun couple, and they had come in, or I got a phone call, hey, we need to meet. And I could tell something was up. I didn't say anything on the phone, and they're such a fun, bubbly couple, and they'd come in, and I could tell something was up right away. And they weren't their jovial, super fun self. And they came in, sat down in the office, and they're like, well, you know, we have a couple things that we really want to share with you, but before we do, do you mind if I pray? And I'm like, oh man, what's about to happen? You know, and you're instantly thinking, what did I do? You know, whatever. And then we open the meeting in prayer, and then he's like, well, you know, my wife just got diagnosed with breast cancer. And I got laid off last week, or in the span of a week. He goes, she got diagnosed with this, and I just lost my job. So we gotta figure something out. So we had invested some of his money. He had his 401k. We basically went to work, pulled up their simplicity plan, and then basically said, how can we generate as much money as possible? We buy as many dividends as we could. We just went to work, and then he instantly went out to find some type of job. He's an older gentleman. The market at that time was very rough. He ended up finding a job, but it couldn't cover his income. We turned down all of his investments. I mean, we just went into action mode, right? So about a year later, I remember this was it 18 or
it's about that time.
2018, where the market had just blown up. Like the whole year it had risen, and then in the span of like 3-4 weeks, the market just, I mean, it
tailed off at the end
it
of the
just
year.
crushed. It was, I think they said it was the fastest drop in market history, of a worst beginning of a year or something like that. And I just, whatever reason, I had this thought, I got to call this client. And I call him up, hey, can we do a review? And it had been a year since we went into action. And we're sitting down, and I'm telling you this story because it has everything to do with this question. And we're sitting down in the meeting, and I'm nervous because the portfolio just got crushed in the market, and fear, and they got thrown into retirement, yet he's still working. And I'm sitting there, and I'm kind of like beating around the bush a little bit, a little nervous, And I remember him, it's like the light bulb went off in the middle of the meeting. He's like, did you bring us in here because you're thinking we're concerned about the value of our portfolio? And I was like, well, I just wanted to make sure we address the market and concerns and drop. And he's like, that's what this meeting's about? And he's like, because if that's what this meeting's about, it's over. And he's like, he's like, and I'll never forget it. Were you in this meeting?
No.
I'll never forget it. He goes, those dividends saved our life. He goes, we got thrown into a horrible situation, my wife and the diagnosis she had and my job. And he goes, if it wasn't for those, we wouldn't be sitting here today. And, I'm not bragging on dividends or the value that we brought. This is real life. These are people who we got to sit alongside. I didn't go through the diagnosis. I didn't lose my job. We just did our job. But they lived it. And here's a year later, and their value got hit, but their dividend remained strong. And he's like, and he literally, those dividends saved our life. And there's so often our clients or people are in situations where they're like, I wish. And here's a situation where somebody's like, no. Like if he ever sat down with another investment advisor or goes to those like free dinners or whatever you have to, and they're like, hey, come buy this product or there's no way the conviction that this particular client has over this, like how would your life change? He's like, my life changed and was able to stay consistent because of dividends. Like that is super strong. And that happened overnight where he didn't have a portfolio of dividends he'd been growing since he was 25 years old. He had a small portfolio with us, and then we basically built a bigger portfolio because he rolled his 401k. And the revenue, he didn't spend a dime of principal. Yeah. And he was able to live off of his dividends plus his part-time job, and then everything's gotten good. The rest of the story, she's cancer-free, he's got a good job. I mean, super awesome situation with this particular person. But we see that time and time again where your life does change and you can pursue your dreams, you can travel. We've got clients that do all kinds of stuff. And they're not fearing over market and political and economic whatever. They're like, yeah, my value's going to go up and down, but the consistency of that dividend and the patience that I have to have on the market, but the reality of that I get on my income, I mean, that is just, it changes people's perspective.
And peace of mind, whatever your dream and your goals are in life, peace of mind is so big. Whether you need that income or not, knowing that it's pretty stinking predictable that it's going to come in, regardless of what you need it for. That was awesome. That's a touching story. But just whatever your dreams are, that peace of mind to be able to know that you can.
So let's talk about what dividends are really briefly. So who wants to put out the first shot? What is an actual dividend?
So if you own shares of a company, you're a part owner of that company. And a lot of these, we call them dividend paying companies, want to give back part of the earnings. I mean, what benefit is it to me of owning that company if I'm not getting anything out of it? And their philosophy, their business model is to pay a portion of the income back to the owners.
So it's either that model or the growth model. And the growth model is, hey, we're not going to pay any portion of our profits back to our investors. We're just going to watch the stock price go up, hopefully.
Right.
Or watch the stock price go down because we placed a bad bet. At the end of the day, investors are either going to hope that the value of their stock goes up or they're going to cash in on a dividend. There's no in between. It's either one or the other. So you have the potential for stock growth on the dividend side,
Yeah.
but you also get paid, as opposed to just the hope for growth on the growth side, the non-value side. So that's how dividends work. Why do companies pay dividends? So there's lots of different reasons here.
Yeah, one is to reward that shareholder. Like you're an owner in the company, so it's the way for you to get a paycheck and to get compensated for holding your money and keeping it with that company.
Yeah, and actually,
Build confidence.
we put down here attracts and keeps investors. But the reality is, when the stock market's volatile and you lose money, what do you want to do? I want to get out.
Yep.
But if you're getting paid, if you have this stock you buy for $100 and you're worse, you buy it at $100 and you're like, it goes up until I buy it. You're that guy, right? And then you buy it at $100 and then within 2 weeks, 3 weeks, it goes down to $70, but it's paying you cash. Mm-hmm. Do you want to get out? Yes, you still want to get out, but that dividend, if you're like my other client or like so many of those clients, you're like, no, I need that cash.
Might allow you to be patient.
That's where that patience comes in and saying, you know what, I'm just going to let the market things settle, unless it's like something catastrophe where the CEO was, on embezzlement charges or something crazy. If the stock's volatile because of, a legitimate reason, which, by the way, investors need to understand what volatility means and why things happen.
What's really dictating share price.
Yes.
It's all future value.
There can be all kinds of reasons, but if nothing changed, like great example is 2020. Mm-hmm. You look at when the pandemic hit and the stock market fell off a cliff. Was that because every company in the world made bad decisions at the wrong time? No, it's because the world shut down and we didn't know what was going. Yeah, everybody it's panic.
Money. Yeah.
And the market went down. And we had so many clients at that time who were really good investors. They call us up and I'm expecting, panic. I'm expecting craziness. What do? They're like, hey, I got 150 grand sitting in cash.
Right.
Can I give that to you? And I was like, who is this?
Yeah.
Does this really happen? And then it happened again.
Yeah.
And again and again. And these people understood opportunity. People understood that what had happened in the volatility wasn't real. It was reactive. And what happened is, the market went down. I was panicked. Never gone through anything like that. And then what happened was the market it V'd and went straight down, went straight back up. And it was just a reaction, an event.
I think most of the market is so emotional. Mm-hmm. And I think they've got these algorithms that kick in just to take advantage of our emotions.
Yeah.
If the Magnificent Seven all of a sudden were to go down a little bit tomorrow, I bet the rest of the market would probably try to follow it.
Yep.
For no good reason.
It would start triggering all of those algorithms to start selling.
Yeah.
But on the other hand, when you look at the dividend, it's also it gives you a sense of comfort when you can look at a company that can pay a dividend in those times that you're describing. The fact that these dividends in these times where even we're in this business and we're nervous, right? You get a little bit nervous sometimes. And the fact that those companies are paying dividends throughout that's a signal to us as investors.
That's strength.
That's of strength.
Yeah.
Hey, you're going to continue to do that and you can still do that. And we're sitting over here feeling like this.
One of the things
that should be better.
I would tell every investor out there is if you have the ability to go figure this out, you can go to Yahoo Finance for one of these things and go look up 20 years, if you can, of the stock price. And what you're going to see is chaos. You're going to see lots of ups and lots of downs. Okay, 20 years, as long as that pays a dividend. And then go to a website called Dividend Investor and go and look up the last 20 years of its dividend. Do Exxon, Duke, just pick a stock. And then what you want to see is the volatility of the stock price. And at the same time, you want to see the consistency or inconsistency of the dividend payment. So what you're really looking for is, in the face of volatility and market movement and economic chaos, how have they paid their dividend? So if you see consistent year over year of payment of that dividend and consistent growth, you might step back and go, hey, that company is really strong, because their stock price, over that 20-year period might have varied 100%, like crazy volatility, and yet never wavered once on not only paying, but increasing its dividend in light. Like overlaying those two charts would be amazing from an investor standpoint, going, hey, there's something to that company. It's super strong. It's got cash flow, and there's lots of reasons. And this isn't the show that we're going to go into to be able to figure out which companies those are. But having that insight as an investor, which we look at, go, hey, we're not that guy that says, just give it time. It's going to come back. No, you have a legitimate reason, a payment. This company is dedicated. They have a long-standing history of making payment, increasing that dividend. And we're sitting back going, no, we're collecting that. And now what we get to do is reinvest that at a much lower price. Why? Because the market's a little nuts right now. And it's gone down for unconnected reasons to this stock. It's just when the tide goes out, everything's affected. And if the market's being volatile going down and our stocks or dividend stocks go down, but it's not as a direct result of what's happening in that company, that's not a bad thing. That's an opportunity. That's where clients should be like, hey, can I give you some more? Can we invest more? Yeah, it's actually happening automatically because they're paying you and we're already reinvesting on the downside.
Which is a great way to get ahead, like some of those previous people that we were discussing at the beginning of the show.
That's what happens.
That consistently just purchasing
And
always.
let's talk about the power of compounding interest. So I know we're going to skip over some stuff, but the compounding effect is one of my favorite aspects. Was it the eighth wonder of the world?
The eighth wonder of the world.
Compounding.
Einstein, wasn't it?
Yeah, that's
I think it was
Not
Einstein.
Charlie
most
Bowers?
brilliant people. Yeah,
I thought it was Charlie Bowers.
He is a doctor.
He is.
So my favorite aspect of a stock is the fact that of a dividend paying stock is we get to reinvest, and this compounding interest in and of itself is powerful. So if you think about, a stock that's paying 5% or it gets 5% growth, you get to invest that. So you have the original investment plus the growth, and then they both get compounded. And then next year you have that value plus its growth that gets compounded. And this is why it mind boggles, because you're like, man, how fast can this thing grow? But you add in the volatility and the reinvestment of a dividend, now you have a stock that drops and you get to buy on the cheap. So you go grocery shopping, you got coupons.
Everything's on sale.
Everything's on sale, and you're buying a great product on sale for no legitimate reason. Like there's no good reason why it went down. It just went down.
Right.
And now you get to buy it down here with last year's payment. So you still got the income value of when it was high. It dropped by 30%. So you have this value to buy. You bring that income down and you got 30% more. Why? I don't know. God's good. I mean, crazy as happens, right? And now that stock goes back up.
Patience. Hate to bring that word up again, but
no, I don't.
you're being rewarded for patience.
So let's think about this from an investor standpoint, and we're charging them. They're paying the investor, or they're paying their advisor to manage their portfolio. What happens when the price goes up?
It is more expensive to buy shares.
Yep. So
And they're paying
getting
their
less.
advisor more.
yes. So when stock prices go up, we make more money and the investor buys less. But the psychology says, yay.
That's right.
We're making more money. My
Yeah.
statement says I don't have 100 grand, I have 150. Yes. But the reality is you're paying me more for something that, to be honest with you, that I had no control over. Did we earn it? We could say we picked the right stocks, but the reality is we didn't do a whole lot other than do the research that we do, and the investor's still getting the same amount of income. Because as the portfolio rises, it doesn't have a direct effect on the income that it pays.
But that's a marketing line that some of these companies use. You see publishers.
Don't get him going on that.
We
Don't
do
get him
better
going on
when
that.
you do better. You know.
Is that trademarked?
I don't know.
We won't throw them completely out.
But the reality is when the stock prices go up, we feel better,
Right.
but it costs us more. Cost the investor more, cost everybody more.
In
What
both
happens on the
ways.
yeah,
Right?
everything.
Like the income and
What happens when the price goes down? Is it the opposite? Is that true?
no. Well,
Yep.
they are able to purchase even more shares.
They're buying more.
Yeah.
because it's on discount, and then they pay us less.
So, but the psyche
Hard
is
to
now,
do.
It's bad.
It's hard
now
to
we
do
feel
those
bad.
emotions.
Yeah.
So let me get this straight. The market goes up, everything gets more expensive, and you pay your advisor more, but
And we
you
love 'em
feel
more.
good.
Yeah, we feel good.
But when the market goes down, you pay your investor or your advisor less. you buy more of your shares,
Income, yep.
but you feel worse.
And your dividend rate's higher too. Yeah.
Is this real? Like, is this backwards?
Yeah.
Like, is this crazy?
That's one way to look at it.
Yeah.
Everybody
What's another way of
likes to
looking
see
at
the
it?
green numbers. They don't like those red ones.
Yeah. So the compounding effect when it comes to the market going down is just mind-boggling. It's everything of the eighth wonder of the world compounded with a little bit more, because now you're buying it on a discount and the compounding effect goes way better.
Well, and then talk about that recoil whenever it finally
yeah.
does, because we know over time it's not going to stay down forever. So you've purchased all these additional shares because it's been discounted. Now the stock price starts to move up. Well, now you have all of these additional
maybe
shares.
You have 10% more shares.
That's right. So now you really start sprinting out in front of someone
Like that
else
at the end of
just
that horse
held.
race. You got that slow, and then all of a sudden that horse, that's how it is when it comes back. It like jumps off the page.
Yeah.
But until you go through that, it's hard. You don't understand it. It plays on your emotions. It's the opposite.
Even when you do go through it, it's
yeah,
hard.
even when you do go through it, it's hard. But
The last thing I want to talk about here is return on initial investment. And this is something, for whatever reason, companies are not good at displaying. So when you have a statement come in, you're not going to have like this number on your statement. I wish you would, because this is in my opinion, the most valuable bit of information you can understand about an investment that you make. So let's give an example here. If you bought $100,000 of a stock, and that $100,000 of stock represents, dividend payer, and it pays you 5% dividend, and then you hold that stock, and I'm just going to throw out just random examples here. This is not a real example. That $100,000, it doesn't even matter where the value of that stock went. So we can assume it grew a lot. We can say it stayed the same or went down. But its dividend went from $5,000 to $17,000. Now we can come up with a multitude of stocks that have done this over just about any year range. The return on initial investment here isn't 5%. It's 17%. Because if you put in $100,000 and that 1 year is generating you $17,000 of dividend, what just happened? You made 17% on your initial investment that 1 year.
Yeah, that's that 1 year.
That 1 year.
You've got all the years prior that have stacked up to get you there.
Which is
as
crazy. So so often we are trained, I think, to think cost basis. And when it comes to dividends, custodians got it wrong. Because your custodian, they're filling out their statement based on what you are required to give to the IRS. So if you invest whatever and you return whatever, they're not going to show you the true value of what you've actually made. They have to give you what you need to your tax person. So because the government's knocking on somebody or all of our doors going, hey, I want my tax money. So your custodian, your bank, your institution is required to give you the information you need to give to the government. They are not giving you return on initial investment. They're not helping you understand the true value of that investment. Because what happens if you have a $100,000 investment and you're getting dividends, every time you get a dividend, it adjusts your cost basis. Now, you didn't give them any more money,
right,
but the government says you did because they paid you a form of dividend, which is like a deposit into the account. So your cost basis goes up. So what happens here is it messes with their mind a little bit because you're like, hey, I put 100,000 in it, but my cost basis is now 150,000 and the value is 200. And you're like, I've only made 50 grand. No, you haven't.
Yeah, you made
You made $100,000.
and so much more to come as a result.
Yeah. So there's a little, and I don't think these institutions are doing this on purpose, but it is a little it's confusing to the investor trying to understand what they actually have made. And that's hard. It's hard on us because that gets lost in translation.
Well, in your statements, like you said, they're specific for the IRS and for filing taxes for that tax year, even.
Yeah.
Like it doesn't even show you
History.
the history of your growth. Like even if you're the growth investor, it's only for that year. You can't see what 2020 was compared to this year. You'd have to go dig up those
I know.
statements, reflect back and forth, do all the math, and then figure out where your actual
and the crazy
return
thing is, your custodian, your bank, they know exactly what you've deposited. Why can't they show that number on every statement? Like, hey, you've only deposited this amount of money. It never changes, and only unless you would deposit more. So if I never gave more than $100,000, so I put 100, and the value is whatever, 200, but I never see what I originally invested, we forget. Life happens, craziness occurs, and you're like, hey, I made $100,000 here. No, they're going to say your starting value last month was 191. Today it's 200, 192, or heaven forbid, 180.
Yeah.
You know, and you're looking at going, well, I've lost money. No, you deposited $100,000 into this account,
Right.
not 189 or 191.
Yeah.
So things get lost real quick, and custodians are not doing anything about this. They don't, and it's not that they don't care. They're not required.
Yeah.
The government doesn't want to know. They only want to know what's happened in the last year so they can collect their tax. Anything beyond that, you are required. We are required to understand the value of what an investment does for us. This is a big problem in our industry, in my opinion. It's actually a really big problem for investors.
It's tough for the investor. You don't know the full picture, and then you start getting emotion layered in, and you can make some poor choices if it's.
All right, so last thing I want to do here is let's give the investor some ideas on different things that they want to look at to find a good dividend stock. Okay, this isn't an exhaustive list or anything like that, but these are some concepts that we want to put in front of you that as advisors, as investors, that we look at to find a good portfolio, a good stock to build a portfolio. So the first thing I want to, is probably the most obvious, is the yield. Right. So what is the company, the stock, the dividend company, paying percentage-wise?
Relative to the stock price.
So that's the big key here.
Yep.
So it's a dollar amount that gets related back to the stock price, which gives you a yield. That yield goes up and down as the stock price changes because it's a set dollar amount. So let's just say they pay $1 and the price is $100. So if it pays $1 and the price is $100, what is the yield? 1%.
Yep.
If that stock goes down to $50 and it's still paying $1, what is the percent? $2. So the reality of what happens here is that stated yield of a dollar amount now looks like it's fluctuating, which the psychology back to the investor goes, hey, that rate's always changing.
Dividend must always be changing.
Yeah, so if the portfolio goes up, I get paid more. The portfolio goes down, I get paid less. Nope, false. That is not true at all.
Actually works in the
Yeah,
inverse.
it
Does, but that's the way we think.
Yes.
If the portfolio goes up, I make more. But the reality is, if the portfolio goes up, because it's a stated number,
Ratio
the
goes
rate
down.
goes down.
But
So
you still make the same.
You still
get
make
that
all
dollar,
along,
whatever
it's
it
that
is.
it doesn't matter.
Yeah.
Right.
So you need to know what the yield is, but in a dollar, in the dollar sense. So if it's $1, $2, $3, $4, whatever it is, you want to know what that number is. That's the first and probably most important, because you want to know, does it actually pay a dividend?
Right.
What else?
My other one that I really like is just the history. Like, how long have they been paying a dividend? And are they consistent with it?
Well, and because a lot of people say, what dividends they're not guaranteed. But, I think I stole this from you. It's pretty darn predictable, though. It might not be guaranteed, but it's pretty predictable when you look at companies. You can't help but bring up the Pepsi and Coke. They've been paying since, 1892 for Coke? 61 years, I think it is, they've consistently increased. So, no, it's not guaranteed, but it's pretty stinking predictable. And to look at that over history, that jumps off the page. But
you got to be careful with that, because we want a good dividend yield. All right, I can buy something for 2%. Why wouldn't I want to buy this one at 12%? Well, what's
it only
the
pays
dividend
12%.
safety? How strong is the company?
Yeah.
Because you can easily get sucked into that. Oh man, this pays 15%. Why wouldn't I?
and that's
Not
why you
all of
can't just
these.
look at one of these things in particular.
We get asked that all the time by, I would say, the newer dividend investor, where they're like, hey, I know our portfolio is yielding X. I've been doing some research and I found these dozen companies that pay 10%.
Yeah.
And then I'll do a quick glance. I'm like, yeah, I saw those too. However, if you dig a little deep into their books, you'll find out that XYZ is taking place, and we don't think that's a good bet. So the reality behind all the things that we're going to mention here is understanding the yield and understanding the price is just that, an understanding. It's not a reason to go buy it. If you see the stocks going up and the yield is, 10%, that doesn't mean, oh, I need to jump on that because the stock's going up and I'm getting a 10% yield. That might have mean that the stock used to be 4 times higher,
Right, and now it's
dropped because of all kinds of commotion, bad running of their books, lots of debt, all kinds of reasons to scare you. You didn't pay attention to that. Now the stock fell. It's on its way back. But there are still so many red flags and reasons to stay away from that we'd go, there's no good reason.
Might just cut their dividends.
They're on a high-paying dividend stock might soon be a no-paying dividend stock. Safety score is another one. This isn't shown on a whole lot of sites, but it's basically a calculation that can be generated by a multitude of different ways, and for an investor to understand how secure is this. And they'll take into considerations like how long they've been paying, how much debt to equity, what's the payout ratio. There's lots of different things that they'll take into this consideration to tell the investor, hey, let's just say the scale 0 to 5. 0 is like, bad bet. 5's like, it's as strong as you get on our scale. And they'll put that somewhere in between. And this tells the investor, hey, there's a lot of legitimate reasons to buy this one or to feel good about the payment of this. Dividend, safety, meaning it's going to pay. There's like a 100% chance, by this score.
99.
Yeah, 99. Or there's like no chance.
Yeah.
There's strong chance that it's actually going to get cut or something like that. Another one is probably my most important one. It's the free cash flow. So one of the things I love about Warren Buffett and how he approaches a business or an investment, he doesn't look at the cash the investment's kicking off or the value of the company. He looks at the potential for what that company can do. Free cash flow is basically that. It's after everything's said and done, the money that's left over. So when we're looking at a company, let's just say their revenue is $1 billion. After it's all said and done, how much money do they still have on hand? Do they have 550? Do they have 800? Do they have 50? Or none, or they running in the black, or running in the red. So the reality behind that is, I want to know as an investor what's their history of their free cash flow. Is it going up? Is it going down? Did it get killed one year? And what was the reason for it? Was it legitimate? They acquire somebody. What's happened to their cash flow, and why? That tells a guy like me or portfolio managers like us a lot of insight into a company's and cash flow and how they manage it, and not to mention what they do with their debt. Like, I love to look at that. Like if you own a stock in a company, that's debt really back to the company. So how do they handle that? How much overhead do they have on expanding? You look at an Amazon, their infrastructure is insane. The amount of debt that they carry is like, I would be shaking in my boots. Yet they make so much money and they have such good cash flow, a free cash flow. But they manage their debt, I think, most of the time very well, and they don't want to get ahead of themselves. Now, they don't pay a dividend, but they have proved time and time again that their model works very efficiently. I want to look at the same type of company that does the same type of management, but pays a dividend.
Like a Walmart.
There's a lot. And Walmart has just about the same type of infrastructure.
Yep.
Not close. Yeah, really close.
I learned the value of free cash flow in 2020 whenever you and I were, like, it was kind of in the height of everything dropping. We went and ran a report just to see of the portfolio, how much cash did our companies have. And it was in the trillions. And it was like, you could just kind of take a deep breath. It was like, all right, there's enough cash sitting in these companies. They can pay out their dividend for years without ever adding
making
to
any
it.
more.
Yeah, that was comforting.
Yeah. I mean, if you look at the cash flow that sits in our portfolio on a day-to-day basis, it's comforting. And that's something, again, you don't find on statements. You don't, all this information, and it's hard to dig up, and find out what a company has. There are requirements to put it out, but they don't put it out in a succinct way. It's not easy to find. No Yahoo portfolio management tool or whatever has any of that information.
They don't give it on the summary of the earnings call each quarter.
Yeah, like
You're
gotta
lucky
dig
if you even get like what they have in free cash flow for the quarter, much less cumulative sitting in the bank.
So that's really important to know. I mean, this is just a summary of some of the things that we think is important, but there's so many other areas and things that we look at in deciding what's a good company, what's a bad company. This isn't the show to help you do that, but we did want to touch it, because it is important, because we bring up, patience and investing and, sitting in stocks. Well, we didn't want to just be like, all right, good luck. We want to give you a little bit of insight to things that we look at.
Well, and the things that you can rest in to help you be patient. When you start getting antsy and you start wanting to make moves and maybe sell out of position, go reaffirm yourself. Look at a couple of those things to remember why you're actually being patient.
Good point.
So last thoughts?
I think we get in. Stay patient. Keep adding a little bit, even if you don't have a ton. Every little bit matters. We've got some people to look at in our history and some current people who've showed that if you're patient and you get in, even if you got small amounts or large amounts, you can do some pretty good things with some patience in dividend investing.
I think to just piggyback on what Nikki was saying, every little bit just continues to compound on itself.
That drip.
And patience is also just time in the market. And it's very hard be hard to beat consistently putting in something, whether that's just the reinvestment of a dividend or additional cash, and not seeing that grow to something much, much larger.
Mm-hmm. Anything you want to add?
Don't you wish you'd started this 50 years ago?
Yeah, exactly.
That's so awesome. Actually, my last thought will be about something that happened in our study group in October, sharing some insight, about investing and planning. And one of our advisors, who is a little older than all of us, leans forward to Kyle. What does he say?
He goes, "Man, wish I'd have found you guys sooner."
Oh.
He's like, "I'm having the most fun I've ever had." And, he's in his mid-70s and just loving it. And he fully grasped this. And he was a guy he was a growth investor. Like, that was the type of advisor. Mm-hmm. And he was just like, where has this been? His words on the phone the other day is, it's hiding in plain sight. It's right here in front of you. Yep. And most of your mutual funds are invested in these very same companies. Just you're not getting the full benefit of it by not owning the stock by themselves.
So when you make decisions to invest, there's more to your statement, there's more to your bottom line than just your value. This entire show was really about the concept of being patient, about understanding what you own and why you should keep it when times look bad. So the realities behind investors and the decisions that you have to make have to go far beyond just what the bold is on your statement, and every statement shows that bold, their value so many times. Well, 9 times on our statement, but it might be more or less on yours. But the realities are, there's more to your bottom line of the value of your account. If you have any other questions or want to ask us a question regarding anything, you can always reach out to us. Hope you enjoyed this show and learned a little bit today.